but it really is actually related to the biodiversity that we're looking to preserve in many places. So, all of these things are linked together, and I think that we're at a point now of it's hopefully a positive tipping point. Getting the support from Singapore government, but also the other governments around the world, whether it's the UK, European governments, Brazil, Indonesia, all of these countries.
Japan.
Yeah, exactly. Japan is going to be doing some really interesting things next year around the GX League. That's now going to become a proper ETS from, I believe, April next year. So.
All right, welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside co-host Rene Velasquez. Today we have a fantastic guest, Chris Leeds, Head of Carbon Markets Development at Standard Chartered Bank. Thank you, Chris, for joining us.
Thank you. Thanks for having me.
Thank you. We're excited to dive into a number of timely topics around the carbon markets, from integrity in finance to policy and the road ahead. And I think it'd be great just to start off if you could give us a brief background of your experience in the markets and what your role entails at Standard Chartered.
Yeah, great. Thanks, Eddie. Well, so as you say, I'm head of carbon markets development. So it's really around the roles around developing our carbon markets business at Standard Chartered, both on the trading and financing side, on compliance markets and the project-based markets, but also a lot of what I do is then actually trying to help the market form externally. So that's why I sit on the board of the Integrity Council, the ICVCM, which we'll talk about a little bit more later on. And I'm also involved in quite a few other initiatives, like on the board of Carbon Place. I helped set up Climate Impact X and a few other things there. So really trying to get the market to work. I'm very much aligned with you guys in terms of trying to really get this market to work. So I think it's important, and it's an important way of getting finance into these projects that really, really need it and wouldn't get it otherwise. My background, I've been in commodity markets all my life, but I switched into carbon about 20 years ago, and I set up the EU ETS at what was Merrill Lynch back then. We traded clean development credits, and the whole of the ETS. Very interesting, and again, it helps shape my thinking around how we can make this market work. The linkage between the EU ETS and the CDM was really clear, and it was very easy to manage for traders and for risk managers, but also then for project developers and investors. So, it's something that I bring to the table a lot. I got back into this market about 5 years ago through helping our CEO, Bill Winters, who was the chair of the Taskforce to Scale Voluntary Carbon Markets. So I supported him on that, and then obviously that led to the to setting up the ICVCM, and I joined the board at that point.
Awesome, thank you for that. And diving right into things, because we've got a number of topics to cover. Talking about the ICVCM, right? They've introduced the core carbon principles as a global benchmark for high quality, high integrity credits. However, it seems adoption remains uneven so far. Not all project standards or buyers have fully embraced the CCPs. So I'd love to explore why these principles are so crucial now and what it means for the market stakeholders, right? So why do you think the core carbon principles are so important at this stage of the market?
So I think actually that they are more important than ever, because they give that grounding, as you rightly put it, of that high quality carbon credit, what we need to see for those projects to be developed. But you've actually now got a proliferation of standards. You're seeing even more standards that are developing. So it's not just gold standard, but it's like carbon, it's GCC, it's Puro for removals and Isometric. So you're now seeing even more standards than we've had before, and actually that's great, because it shows that there's a need, there's an interest, there's a desire. Many of these are coming from regional programs as well. Is a need for innovation. but it makes the landscape even more difficult to navigate for buyers and investors. So how do they get to understand that market, and how do we ensure that quality is consistent and even? And that's what the CCPs are there to do. And the ICVCM spent a long time developing the CCPs, as I'm sure you're aware. And doing the assessment. It's not just the CCPs; it's the assessment process that we go through. This two-tick. First of all, assessing the program itself, the crediting standard, and then assessing the methodologies. And this is really important because actually, by assessing the crediting standards, we're saying, you have the governance, you have the professionalism, you have the resources and personnel to be able to actually run a program that, if it's done properly with the proper measurement, reporting, and verification, with the verification and validation bodies working properly, then the credits that are generated by your program will be high integrity. They will meet the criteria that we need, which is to actually reduce or remove a ton of CO2. That they really do represent a ton of CO2. That's first and foremost. But also, of course, they have all of these other wonderful attributes that more and more are now becoming just that's the minimum around things like the Sustainable Development Goals, the SDGs. Ensuring that people actually go beyond just the environmental attribute, but that is the key. It has to represent a ton of CO2. So the second phase is then obviously assessing the methodologies, and again, we then decide whether these methodologies are going to be good enough to generate credits that meet those principles and meet that criteria around the environmental efficacy. So, that's why they're really important. And if we start to get more and more buyers saying, I only want to buy credits that are CCP labeled, and they know that they're getting that quality tag, if you like, that flag, then more programs will go, well, we've got to be in there, and more methodologies will get assessed, and you'll get a crowding in. You'll get a race to the top in terms of quality, and that's what we really want to see. Now we've already assessed 7 programs. There are another 7 programs in the pipeline. We've assessed pretty much all of the methodologies that generate credits, and that was the focus, was to go for those projects that are already generating credits, that are already in the market, so that we can ensure that there's that certainty around them. But this is not about looking backwards, it's about looking forward. It's about creating a market that's fit for purpose, fit for growth, fit for the future, to generate carbon credits that are going to do what we want them to do, which is reduce or remove a ton of CO2, and that's going to get money into projects that just don't get it otherwise.
Yeah. Rene, I feel like you're itching to...
I'm nodding in the background. Did you see me doing that, Eddie? Chris, welcome, and I love this conversation already. It's really insightful. So, firstly, congrats on the amazing role that Amy and the entire team and yourself have been doing at ICVCM. I had the pleasure of seeing her here in Singapore and Kuala Lumpur a couple of weeks back when she was here visiting the region. Just some kind of observations, and I think obviously did an amazing job for our audience in terms of summarizing that 2-tick role that the ICVCM plays. Just curious to get your take on this kind of analogy. So give me some latitude here, but I see the ICVCM effectively becoming to carbon what the Basel Committee and Accords is to banking effectively. So it's a standard setter that defines this integrity and manages the systemic risk, and then effectively helps to build confidence for the institutional capital, right? So in that context, if Basel made the global finance bankable, ICVCM is doing essentially the same thing for carbon, translating like the legitimacy or the integrity into this credibility. Do you think it's an apt sort of parallel?
Yeah, I mean, there's a few bodies that that have done that. There is another one that you could kind of think of as well, and I think of it in a way of, if we get it right, and it really does create that safe space for carbon project developers and for standard setters, and that they can feel confident about this, then it ultimately almost becomes like you have to be accredited by the ICVCM, because that's your license to operate.
That's the license to operate.
Yeah, exactly. And then they can just get on with it, right? They can just do their thing. And obviously there has to be other checks and balances in there to make sure that is actually happening. And I think we're talking, I'm sure Amy probably mentioned it, spot checks, and there will be an ability to actually go back and say, well, have you really done all of that? It's about, for me, I think it's about professionalizing the market. It's about, making sure that project developers really can do what they say they're going to do when they go and develop a project. There are a lot of people in this market who are very well-meaning, but they also need to be really capable. We need that capability, and you need to see that like you would see in any financial market, engineering, bodies, or all these kind of organizations who will ensure that there is delivery, and that it really does meet the criteria
does what it
that
says
we
on the
need it to.
tin.
Yeah.
And so it's essentially governance. And the way I see it is, and also speaking with Amy about this, she had some really great insights on a panel in KL, but basically essentially saying that the ICVCM is stepping into this quasi-regulatory role. I'm not trying to put words in her mouth. It's kind of mean to put
But that's the way we've seen it.
Yeah, not through enforcement, but through, like what you said before, standard setting, where it's effectively self-governance meets supervision, right? So you got the standard setters, now they're being supervised and governed effectively, right, by ICVCM at the programmatic level, and then the methodological level. It gives now the clear signal to the market and market participants to say, hey, the projects that we purchase from are only those that are CCP eligible and come with that CCP tag. And what we're seeing also in the market, and obviously there's but folks that have got data in and around this, allied offsets and others, demonstrate that there's a premium that is emerging in the market for CCP tagged units. And I think there's your intro, you said it, that it creates effectively a race to the top, not a race to the bottom.
Yes.
And so it's a really good standardization, harmonization that evolves from it. The other thing that I want to get your input on is the boundaries between voluntary and compliance markets, which are dissolving. I challenged Amy, and I keep hitting this drum, but the V should just be verified carbon markets, not voluntary in ICVCM. And effectively, she said, this as well, and she challenged the audience at CMI conference in Singapore, basically saying the CCPs are being adopted at governmental levels, right? There are compliance systems now that are emerging that are effectively harmonizing in and around the CCPs effectively, right? Singapore, starting to embed these parameters in their compliance regimes. How do you see that moving forward? Do you see that adoption and becoming more and more prevalent?
Totally, completely. So for me, and this is one of the things that we've been talking about within the board, is, we really need to get that endorsement from governments. It's one of the reasons actually why we've been worked really hard with this coalition, the Coalition to grow the carbon market. So this is the one that's led by Singapore, UK, and Kenya. They brought France and other countries in. It's going to be quite a lot about the shared principles that they're launching at COP. Which I can't say too much about because they're still,
we don't want to steal the thunder.
Exactly. But, I think you'll be quite happy with them, because they really talk about the sort of things that we've been talking about. And it's not just about the quality of the credits. I mean, I'm very much of the belief, the quality of the projects and the credits is paramount, right? That is the key. If we don't do that, then the whole thing falls apart. But even after that, there are other things that you need to see falling in place. So, it's things like accounting recognition. It's the legal recognition of a carbon credit. It's the infrastructure that you need to set up. And then, of course, it's things like, well, why do you buy a carbon credit? What's the use case? Now that can be, obviously, through a tax like that we see in Singapore, where people are going to be able to use carbon credits in lieu of the tax up to some extent. It could be against an ETS, as I said at the beginning, similar to what we saw in Europe at the start. And other countries are doing that.
But isn't history repeating itself also in Europe? Now we're starting to see the emergence of crediting mechanisms under the ETS, because they're running out of the low-hanging fruit.
Exactly. They're realizing that if they just drive down this route, they're going to be putting. I think the cost of abatement in Europe realistically is closer to $100 to $200 a ton. And
especially now with expansion under the second expansion of that ETS2,
that's going to be
it's going to be really interesting to watch, and they can ill afford having really, really high price signals, because it'll be felt at the ballot box effectively. So you need to have pressure release felt.
Exactly. But it's also illogical, right? Why are we going for the most expensive forms of abatement first? Why aren't we just going along the the marginal abatement cost curve? And there are many cheaper forms of abatement around the world, particularly related to avoided deforestation. It could be clean cooking. It could be certain renewable projects. But that's what we're trying to do with the CCPs, right? The methane's a big area, right? Why aren't we attacking methane? And the CCPs enable that, and that's going to continue to be an area we look at. We're obviously looking at removals, but even with removals, we've got to be careful that we're not going for these extremely high-priced removals that don't scale versus ones that do. I'm all for kind of putting seed capital in now to help scale the market, but we've got to be we've just got to be pragmatic about it because of those costs. We've got to think this has to be cost effective. Voters are not going to accept it. We're seeing this already. We've got to be, commercial about this, and that's exactly what we're trying to do. So I think that's really important to get that endorsement. I mean, you may notice as well, I very, very rarely use voluntary when I'm talking about this market. I talk about project-based credits or
project-based credit.
I don't even really talk about verified, but really I talk about project-based because that's what they are, and you will need project-based credits because they enable you to invest into something that will actually help you to reduce emissions or remove emissions, that help you to put new, roll out new technologies, help to experiment, to focus on particular sectors and things like that. So, the ETS in Europe only covers 50% of emissions, right? So what about all the other areas related to forestry or, energy efficiency in areas like that? So I think it's really important. Other thing to point out is that when we talk about using carbon credits and carbon markets, and people getting vexed about whether this is acceptable for companies to use carbon credits as offsets and to help them meet targets. Well, it's been endorsed by the UN, right? That's the whole point of Article 6. So there's agreement by over 190 countries. So we should move on from that. Let's just get the market working. Let's get these issues resolved around simple things like the accounting standards, and I say simple, but simple conceptually, but the detail is a lot more complicated. But let's get them fixed. Let's get the legal issues resolved. Let's get capacity building in countries across Africa, across Southeast Asia, to allow them to build the infrastructure to facilitate carbon markets. That's all needed as well.
Yeah, and I think what you just articulated, can I jump in here? Because I think
go for it.
What you just articulated sounds like the need for market standardization, right? And that's the way that this market is going to scale. So today's voluntary market still suffers from fragmentation across, a plethora of registries with different rules, different project methodologies, non-standardized contracts, or documentation. So I would love to discuss where standardization would matter most. I think you just hit on it a little bit, but I want to double tap there. So where do you
can I give some color on that, Ed, before we hand it to Chris on that? Because I completely agree with that statement, and I want to give you my opinion on where we sit. I'd love to get Chris, your take on it, and also just some broader context about that word scale. And I'll add one more word to it, it's speed. So I completely agree. I think in the first innings of this match, effectively, we tried at Expansive, right, in the first wave to standardize contracts, right, and that we saw the market really latch on to that concept around standardization with the launch of the Geo and the NGO contracts, and they were two of the most successful launches that CME has had in their history, interestingly. And all the perfect ingredients were there, right? Market ambition, extra liquidity in the system, and commitments around decarbonization, all coming together at once. We standardized these contracts and basically rationalized that market focus and did away with the bifurcation around price signals. And we saw those contracts becoming benchmarks. But then what we didn't bank on was a systemic shock to the foundation, right? Essentially challenge on the programmatic and methodological underpinnings. We assumed that the standards would provide that, right? And so this is pre-ICVCM. So what ended up happening is that those contracts didn't succeed in the end in terms of liquidity as a metric because the underlying units weren't necessarily of the highest integrity, and I'm pointing to red in particular here being
Yeah, and so I think that's the big difference.
Yeah,
But
so now you've cleaned it up and effectively said, here's a foundational structure to build upon. And so now the next evolution of contracts that emerge in the exchange ecosystem should now be based on a much, much stronger foundation. So we can see rationalization and standardization of the standards that underpin the foundation, and then layers built on top of that. Thoughts?
Exactly. So I think that we will have a set of projects, methodologies that are going to be that meet the criteria, that we're all comfortable that are doing the right thing. Are there going to be issues? Are there going to be credits that don't meet that criteria? Absolutely. But that's also then we've got to work out how we're going to react to that, because it's going to happen. But ultimately, we should have sufficient number of projects and methodologies that do meet that criteria that can create an index or set of indices. And I'll come back to that in a minute.
Indices.
But the other thing is then,
let the market decide.
Yeah, well, it's absolutely, but it's then getting that endorsement from government, or at least some kind of air cover that says, we think this is okay, we think this is the right way to approach it. Maybe even they'll buy credits on that basis for their own government uses, or whatever it happens to be. Singapore is really stepping up in this regard, and I think other countries will follow suit, and that's exactly what this coalition's about. But so that's really important. So you get those conditions there that creates the demand, right? And then I think demand is the key. Yes, absolutely. We need a set of contracts, and the GEO and the NGO were good contracts from that perspective. But if the demand for those credits isn't sufficient, isn't essentially large enough to create the signals, then you get things falling away. Because where you would expect to go anyway is that we then start to move up the merit order. The prices go up, and so the cheapest to deliver isn't then necessarily the clean cooking project. It could be some other avoided deforestation, or it could be some other new technology that's being developed that's going to actually be more expensive. And I'm not saying that price and quality are correlated, but certainly when you've got higher prices, it then means that people are going to be very, very keen to ensure that those credits and those projects really do deliver, right? So the buyers of those credits,
and also encourages greater participation. It actually helps accelerate the decarbonization. No, I completely agree.
It creates that internal pricing signal. So that's one of those things that I want to see, because if you're paying $2-3 a ton, maybe it isn't going to create the right signal internally. But if you're paying $20, $30, $40 a ton, I can guarantee you that the CFO is going to be interested to know what's going on. They want to know that those carbon credits are high quality, and they will want to know if there are ways that they can reduce the number of credits they need to buy. They're going to ask people in the group, well, why don't we just reduce our own emissions? If we can reduce it at 20 and we're having to pay 30 for carbon credits, why don't we? That is the way it should work.
That's the rational action, and that's the going up the margin abatement cost curve. It sets that signal for that internal decarbonization and makes it rational internally. Completely agree. One other thing that I want to come back to, something you said earlier around this kind of agnosticism around not backing certain methodologies as winners. I think that's the right approach, right? And I love that, again, what the ICVCM is doing here by creating essentially that governance to say every program, every methodology should be welcome as long as it adheres to these principles. And it kind of goes to this this book by John Doerr called Speed and Scale, right? And the message was really simple. Like the climate crisis is a race against the time, and we don't have the luxury of choosing these favorites. We need basically every credible solution moving forward simultaneously. And so essentially speed without scale is a sprint to nowhere, right? We need scale without speed is complacency, effectively, and the carbon market needs both. And that's the kind of thesis that I kind of espouse.
Absolutely, and there are technologies today that will help move the needle, and they're not getting enough money because people aren't actually, won't allow that to happen. I mean, the idea that companies are buying carbon credits and then just going, okay, that's it, I've done my bit, it's been proved wrong time and time again by the research. Companies that are buying carbon credits are the ones out there trying to do something and actually trying to reduce emissions, trying to account for emissions, trying to actually make disclosures around their own emissions and get others to do the same. And it's interesting, we're starting to see certain companies pushing things down their value chain, and I think that'll be really powerful, saying, hey, if you want to be my supplier, you need to go and do something about your own emissions. And one of the ways you can do that is to buy carbon credits. We're not saying it's the only way. We're just saying it's one of the ways. And it's a way of compensating for your own emissions, but it's also a way of getting money that just won't get there otherwise. And it's the only way that we can see scale. Governments are not going to do it, right? We've just seen this with the, with the results at the last COP. The 1.3 trillion that gap is not going to be filled by governments alone. It needs private sector.
They're running deficits. You need to leverage the private sector completely.
And this is where the carbon market can come in. We get the quality right, we get the claims that people can make, we get that recognition right, so it creates the business case, right? Without a business case, it's just philanthropy, and that is never going to move the needle. Whereas if you actually get the right business case, exactly, it goes back to your point about scalability. And we've got projects that can get scaled up right today, but there are many projects that will scale up down the line. But that's what price signals do. That's what forward markets do. What I think is really interesting is that we are seeing these forward purchase contracts, these offtake contracts being entered into, because that creates the certainty for future delivery. It creates the certainty for emissions reductions and removals down the line, not just today, right? So buying carbon credits that have been issued, and certainly from kind of the previous the previous set of credits, that's okay. It's recognizing effort that's been made already. But what we really want to see is more money going into new projects and new technologies. So that's where it really is going to make a difference. And then also what happens, this is the other important thing about standardization, Eddie. It's the fact that then as a banker, as the finance can come in and they can go, well, hold on, how are we going to manage the risk around this? What happens if these credits don't turn up? How do I manage that? Well, you get insurance to a certain extent, but you also get ability to use replacement costs. You can say, well, if I don't deliver that credit, I can use this one instead, right? You get that fungibility, get that interchangeability of carbon credits, that standardization, so that people go, I don't mind if I have that credit for clean cooking, or if I get that one for avoided deforestation, or for methane destruction. I don't mind, as long as it's doing what it's supposed to do, and that it's actually I can then use it for my own claim. And that will then really drive finance, because we can then manage the risk a lot better. You start to see forward markets develop, people can manage the risk from a price perspective, and then also you can start to see better risk in terms of project delivery. You're going to get more money coming in up front, and so the right developers can use that money to actually deploy capital in an efficient way, and that's what's really important.
Yeah, well said. And I really like the way that that exchange went. And I really like this conversation. So just double tapping on, I want to take a banking lens for a second, or institutional financing lens, right? What types of data and transparency do investors and lenders need in order to underwrite these large volumes of credits and to invest in large projects that maybe they're not getting now in the current state of the market, right? Like, what do you think is holding back institutional finance?
So when we talk about finance, and we certainly when we start talking about bank financing and lending at scale, which is where we start to see things really scale up, right? Equity capital is important. You need an equity investor in there, somebody who's going to take the initial risk, who's going to help to actually get the project off the ground, and is ultimately putting skin in the game there. But for them to really be able to scale up, you need the debt capital. So even if it's a loan to value of 50%, that's still doubling up the amount of capital that's coming in. But if you start to get to 70% LTVs, you're tripling the capital that can come in, and that's going to make a huge difference. But what debt needs is certainty over revenue, and the ability to repay debt. So when you go to a bank, actually, it's not going to be how much can I make, it's going to be how do I get my money back, is one of the first questions you're going to get asked. How do I know I'm going to get my money back? And then we can start talking about returns and ensuring that this is profitable. But if we don't think we can get our money back, we're not going to lend in the first place, right? And that's what we're seeing. And you're still seeing money going into projects that can deliver returns and generate revenue much more easily. And many of these tend to come from, you know, conventional infrastructure projects around the world, many of which are still reliant on fossil fuels. So we want to change that. We want to see capital going into projects in the same way that we would see capital going into infrastructure projects. You know, a proper project finance type model. And the key thing there is the certainty over the revenue. And so that's why we're seeing these offtakes being so important, because if you've got an offtake, then you've got somebody who's willing to pay for that credit, and you know the amount of money that project is going to generate, and whether that can actually repay a loan, right? So that's absolutely number one. Now, offtakes are great, but they do have to be bankable. They do have to be, you know, an even split in the risks. And that means, you know, not putting out too much risk on the developer, who will tend to be probably a lot smaller than the off-taker, particularly as we're looking for creditworthy offtakes. So from companies with large balance sheets, so they tend to be in, you know, the driving seat, but the project developer will then potentially sign up to anything, whereas they probably shouldn't be. And that's one of the things that banks can help with, is to say, well, hold on, you know, if you do this, if you put in this make good clause on your deliveries, and if you don't make good, then there are some kind of liquidated damages. You know, how are you actually going to meet that? So we're looking at that quite closely to ensure that, you know, there is an equitable share of the risks when it comes to putting these offtakes in place. But actually, this goes back to standardization and getting the market to work better. If you had a liquid secondary market and a futures market working, you can manage risk. You can say, well, hold on, I don't need an offtake at a fixed price. I can have it at an index price, because I'll manage the risk in the market myself. Yeah, I'll use a hedge, exactly. And I can go and do that. So we're not seeing that at the moment, but, you know, let's start. We've got to start somewhere. And so fixed price offtakes, or offtakes with a floor price, right? That's number one, you know, requirement. But then we need to ensure that the project developer can actually deliver those carbon credits, because if you can't deliver, then you're not going to get paid. And so then it's looking at the you know, the transparency around that project itself, right? What stage are you at in the project development? You know, whether you've done a feasibility study, or whether the project has been validated. I would say in most cases, a lender will only want to lend to a validated project coming from a reputable standard, and hopefully one that's actually accredited under the ICVCM. All right, so you've got the data around that, and then you can actually see the you know, the project getting developed and starting to generate carbon credits, so that or generate reductions and removals that are then measured. Now, one of the things that we're seeing is a lot more digitization of this process, where actually that information is fed through the registries and the standards much more quickly. You know, that's going to be, again, the bottleneck to getting payment. Really, yeah, you know, you think about it, right? If I'm having to wait a year for the first set of verification reports before I can actually get any revenue, or before credits are generated,
we need it more like a PPA.
Yeah, exactly.
Yeah.
So that's an area I think that's going to be really important.
Can I jump in? Because that was a masterclass. I took a note down earlier. I love how you said, you defined bankability. That was the best. But basically you said, if you can't pay it back in terms of debt, then we're not lending you the money. And that's the most sober assessment I think I've ever heard from a banker. I really enjoyed that. But in terms of some overviews of what you said, right? Like, effectively, to paraphrase what you said, is that right now most carbon deals really look like venture capital, right? And to scale, they need to look more like infrastructure. You said the word infrastructure. And I do think that bankability is the key here. You cited the offtake piece as one of the key components for effectively providing that visibility, you know, around the discounted cash flows from future revenues from the offtake. That's one of the key components. And then it's the credit risk effectively of the counterparty on the other side, or counterparties, if it's a portfolio of different buyers that come into that project. That inherently then makes it get it through the first hurdle, then there's a number of other like components, like you said, the ability to actually execute on that, their existing balance sheet strength, so management experience, and the cap table, et cetera, et cetera, et cetera, right? But it looks like infrastructure, right? And then now you can have multitude of different investors coming in, early stage equity, so venture folks, right? And I think increasingly, it's not the venture capitalists coming in right now filling that role increasingly, and I'd love to get your thoughts on this. I know it might be outside of your remit, but it's family offices that are providing that risk on capital in the lack of, or the absence of, the venture emerging at this point in time. And then there are other more institutional investors that kind of go up that value curve at Series B, that we're thinking the Gen Zeros of the world, and then we can get to the bankability component, right? Because now you've got strong projects. But we've got a just an enormous amount of projects that just don't look sophisticated right now, and they just don't speak the language to the banks. And that's an opportunity as much as a problem.
Well, there's two things I think that can happen. What I think we're going to see less of is financing of just one-off projects. So we're going to start to see more portfolios being developed, and so that does two things. One, it allows perhaps professional project managers and managers coming in who can then aggregate a bunch of projects, working with the project developers who may well be less sophisticated, to ensure that they do everything right, that they go to a particular standard. And then it creates
a platform approach.
Right?
You're de-risking it because it's a portfolio. So you de-risk across standards, across geographies, across timing risks, across all the verification and sovereign risk as well, right? Because you're applying across the globe.
Exactly, and so I think that's an area that we are starting to see, more and more of those develop.
Just for full transparency, we're advising a couple, I won't say more than that, there's two, on that very strategy right now, who are building out those platforms across a multitude of different project types and are looking to aggregate those small project developers that are in that death valley of not getting investment, and essentially rolling them up under effectively term sheets and an M&A. I think that's the next wave that comes through. Once these platforms are well established, then the institutional investors actually can get excited because the ticket sizes are a lot more juicy for them. And they can actually say, oh, it's $100 million. Oh, this is a professional run outfit. And this is what it looks like. Here's the DCFs. Oh, here's the data room. Now it starts to look exactly like project finance. And then you've got folks that have got experience in building out large infrastructure projects, whether they're oil rigs or bridges or airports or whatever it might be, entering this space, talking the talk to the investment bankers and bankers that actually gets the unlock of what you said, the LTV.
Exactly. So, I mean, we did our first, one of our first financings with a company called Curate, who then were working with Undo, who were doing enhanced rock weathering. The offtake was put in place by British Airways. It was a small deal, but it was to try and prove that we could finance these early stage projects, which really were VC. And what we really did find out is actually it is tough. It's really hard, and it's really hard to scale that. So portfolios are one way of doing that. Having a particular vehicle again. So it's all really this kind of idea of generating portfolios. I still think many of the early stage removal projects are going to be difficult to do that with anyway, just because of the technology risk that you've got there, and the MRV, the monitoring, reporting, and verification risks that we've still got on those types of projects. But they'll get there. Whereas what we are definitely seeing is the nature-based projects starting to develop, and we participated. Standard Chartered participated in one of the mandated leader ranges of a 210 million financing facility for Chestnut Carbon, led by JP Morgan. But we were in there along with a few other banks, and that was one of the first non-recourse project financing that have been done at that scale in carbon, and that's going to be the area that grows. And as you say, the kind of portfolios that you're looking at, and that we're looking at as well, that's the area to work on. And I think that can bring in the large scale stuff, but it can also help in bring in these smaller projects and project developers, who we know are the kind of backbone of the carbon market. But right now they're not going to, it's going to be very difficult for
they need to professionalize.
For money to scale them. Exactly.
I think that there'll be a rationalization event that comes through. So I don't know, maybe our team's been lucky in kind of identifying patterns, but this is how we see it. This is the house view, right? And essentially it's this rationalization that's going to emerge over time where the unsophisticated project developers either partner up or get eaten up by bigger folks that can actually provide that rigor and structure and access to capital markets. And then you start to see that capital start to unlock as you get more of that structure. And effectively, the bankable carbon projects of the future will have these three signatures: integrity, transparency, and the tenor. And it's like this sophistication wrapper piece is how we see it. Thoughts on that? And then I've got a view in terms of where we're at in the kind of hype cycle. Like, does that rationalize with you in terms of?
Yeah, no, exactly. And I think that we're going to see. I think we're going to start to see things falling out around, whether it's a UN project or whether it's not a UN project, whether it has a corresponding adjustment or not.
That's just different flavors of ice cream, man.
Exactly. Exactly. And the fact is that the projects themselves are what's important, and how they actually reduce carbon emissions, whether it's going to be to support that country and its nationally determined contribution, or whether it's going to be.
It's just like there's no one flavor to finance. Like it just flows. Like we've got to focus on. So I'm with you on that. Yeah. I think something you said before around this kind of, there's been this push towards durable CDR, and there's a lot of deal flow that's happened in the primary market towards that. But I think that markets just move in these hype cycles, and the Gartner hype cycles are really elaborate and apt, I think, metaphor for this. But you've got this innovation trigger, and you got this peak of their inflated expectations, and everyone's just like hyped, and then reality hits where effectively technical, financial, or integrity in this case challenges emerge, and then the enthusiasm wanes, and then you got the slope of enlightenment. And then this plateau of productivity. It's never as sexy as it was thought of, but it's pretty good in the long run kind of thing. Yeah, and I think carbon's been in that. I think we're at the slope of enlightenment. We're basically, we've been through the worst of it, and now we're kind of coming through, certainly on the nature-based side, because I think that's further ahead in that evolution. But maybe the CDR stuff is kind of at the peak of inflated expectations and will inevitably fall through that trough of disillusionment where that reality hits, like you said, in achieving scale at a reasonable cost. That's going to be tricky.
So I think that's what's interesting is that we've seen, multiple attacks on the carbon markets over the last few years, and we continue to. And there's a lot of pushback, and yet it is still there, and it's growing, and the interest is growing, and we're seeing that. Yeah, it's highly resilient. As I said, the UN has endorsed
the numbers
it anyway.
Don't lie. It's not just, it's just not subjectivity like that they're saying, oh, cool, it's us. No, it is. The numbers don't lie. Like the market is very resilient, and it's growing.
But also, I think what's interesting is, you're based out in Asia. Amy was visiting Asia.
You guys have got your first offices here on the ICVCM side. So
precisely.
Congrats.
It's not. Thank you. Yeah, it's no accident, right? So it's because that's where we're seeing the action. Indonesia has the presidential decree has been passed, and that they are going to operationalize their carbon market. They're going to make sure that it's linked into the international markets. It's really exciting. But we're seeing the same in Malaysia, Thailand, Vietnam, across that part of the world. And of course, China and India are both looking at carbon markets very closely. I wouldn't even say they're looking at them. China has a carbon market. It's the largest carbon market in the world. The China ETS covers 5 billion tons of carbon emissions annually. So it's there, and they're going to be that they use project-based credits. They allow project-based credits to be used within the ETS, and what would be amazing is if they broaden it out to international credits. Now, I don't know if that's going to be likely or not, but that could be an enormous game changer. But Japan, Korea, Australia, New Zealand, they've all got carbon markets. We're seeing the same in South America, right? So Brazil's developing a carbon market. Chile's got and Colombia both use carbon pricing to some extent or other. So it's coming, and it's not even coming, it's just growing now. And again, as I said before, it's about ensuring that we can have the best possible carbon market. And so getting all these markets to link, allowing that fungibility of credits and that interoperability, that's absolutely key.
The interoperability piece. And the global nature of it, like you said. Yeah. Because so I love that thought. And obviously I'm a big proponent of that. I'm I'm buying effectively this thesis that the center of gravity is shifting to Asia. But I'm also cognizant of the fact that the two pillars, essentially London and New York of financial markets, it will always stick around. You know, let's just say Frankfurt and other places, Geneva, also great. But a lot of that shifting to Asia. Singapore is the poster child for it. Essentially, it's a pound for pound champion of Asia, right? Because it's just incubating this amazing ecosystem here. But it centers on policy signal and the strength of that signal, where it's the government and all of the different agencies. We met with the Economic Development Board of Singapore, and they framed it really well, where they're saying when Singapore makes this commitment, it's long term. And so for business planning, you want that level of certainty for 30 years out.
Absolutely.
So you can make a business plan and then go ahead and execute it. Once then a business is set up here, they've got access to capital. Capital's migrated extensively to Asia, and in particular Singapore. Look, I was referencing family offices. They've attracted trillions of dollars in the last years to Singapore. It's a very attractive destination. And then following on, they're trying to incubate the domestic talent, but also attracting foreign talent, the best of the best, to help to foster that innovation. And so you get this petri dish of opportunity effectively just evolving, and it's really interesting. The final thing I'll say is your point around the demand earlier is really salient and applies to Asia, because it's where the largest emitters of the world are, and not just China in terms of the emissions trading system, but supply chains are increasingly throughout this continent, right? Or this region. And so you've got the largest emitters, and then, you know, these really big decarbonization opportunities that are still yet to be realized. So the supply and the demand also coexist in this region, and it's a very fertile ground, choose the pun, for this market to thrive.
Yeah, I mean, I think that's interesting. You know, when you look at somewhere like Vietnam, they're very progressive around this, and I'm sure it's because they're looking, you know, from both sides, right? They've obviously got a lot of natural sinks that they hope that they can monetize, but also they're big emitters themselves, because they are, you know, they're very, very much part of the international supply chain. But yeah, going back to Singapore, I mean, I love the way that they've been very deliberate about this from the off. I mean, I got first involved in the work in Singapore, obviously through the bank. And what we do at Standard Chartered, being, you know, one of the biggest banks in Asia, and you know, we were invited to join the or to become part of Climate Impact X, and the you know, one of the seed investors, because they wanted to bring in an international bank, so it wasn't just seen as a Singapore exchange.
A local player.
Exactly. It was yes, of course, it was Temasek, DBS, and SGX who initiated it, but they wanted us in there to give it that international flavor, which I think it's done. And you know, they're continuing to push forward. They're now looking at providing grants to people to come to Singapore and set up you know, set up businesses, carbon related businesses. I mean, that's
and they're codifying it also in the employment pass, right?
Yeah,
like there's actually incentives and recognition of people that are in the carbon space and are actually investing in the space as well. So it is a fascinating and fabulous ecosystem that's being built here, for sure. For sure. Can I just add one extra bit? I'm obviously conscious of time, but it's not just carbon. Like, obviously we dedicate this podcast and kind of a lot of our work on carbon, but I had a really interesting conversation today with folks in and around the renewable space. I can't disclose too much because they did share some really interesting things with me that are, you know, supposed to be off the record. I'll intimate where I'm going with this, but you mentioned Vietnam, Indonesia, and other countries here are also very rapidly increasing their renewable space, and it stems from the demand for energy in this region as data centers are being built out. And so there's a harmonization. You said it before around corporates looking to engage with carbon. You use the use case of carbon, but in this case also RECs, to effectively help to provide signals to their supply chain, either through purchasing or sort of incentives, and recognition is really key. So the SBTIs play a key role in this, right? Of the world, the greenhouse gas protocols, et cetera, to help those folks in the supply chain to actually do their scope 1 in the case of carbon, and scope 2 decarbonization that affects the scope 3 of the banks, the financiers, the corporates, et cetera. And I think we're seeing a lot of investment going into renewables, and I think that's the perfect example, corollary for what's going to end up happening to carbon. Something's going to click, and we're going to get this recognition across the accounting piece, as you framed earlier, and that's going to create this huge arms race, and we need to be ready for that, because it's just going to go all in.
Yeah, and then at the other angle, of course, is nature, and nature and biodiversity, right? So they're all linked. They're all linked again. Supply chains. You've got a lot of the agricultural companies who are very much linked into into the nature space, and you are seeing more investment and buying of carbon credits in those markets, and that's because also we've talked a lot about biodiversity credits recently and conservation credits and things like that, but it's really difficult to be able to develop a market for biodiversity. But carbon can be a really good proxy, and that's what it's used for a lot of the time. And there may be ways we need to think about how that looks from a claims perspective. But at the end of the day, we need to pay for conservation. We need to pay for preservation and biodiversity, and the carbon markets are a way of doing that, and it's a way of actually getting money in in a way that's objective as much as possible. We measure it. It's called a ton of CO2 now, but it really is actually related to the biodiversity that we're looking to preserve in many places. So all of these things are linked together, and I think that we're at a point now of it's hopefully a positive tipping point. Getting those the support from Singapore government, but also the other governments around the world, whether it's the UK, European governments, Brazil, Indonesia, all of these countries.
Japan.
Yeah, exactly. Japan is going to be doing some really interesting things next year around the GX League. That's now going to become a proper ETS from, I believe, April next year. So, these things are also.
And there's a reliance on project-based approaches as well.
Exactly.
Right?
Exactly.
And that's
in
a
Australia
market that's
as well,
naturally short because it's inherently difficult to unlock those opportunities because of the technology transfer piece. And so there's huge opportunities that price signal will end up creating in the market. I completely concur. It's really exciting.
Yep. No, so I think it's been a difficult few years. I'm not saying we're completely through the woods yet, but I think the next few years is clear. There are many companies who've made commitments that are going to, that are going to come home in the next few years. 2030 commitments and such like, and I think that's going to drive demand. We've got countries are realizing that they've made commitments and then they have to do something, and then they have to reduce emissions as quickly as possible, but at at a reasonable cost, at the least cost. And so again, these are all the things that will help develop the markets going forward.
All right.
Yeah. Awesome. Well, look, that was a masterclass. So thank you so much, Chris, for joining. And whether it's standardization or stronger data infrastructure, the work that we're doing now will shape whether this market matures or continues to fragment. So yeah, really appreciate you coming on and sharing your insights, and love the conversation. So thank you.
Yeah, Chris, welcome. You're welcome anytime. So please join us again. But wishing you safe travels and a really productive trip to Berlin and COP.
Great.
Hopefully, there's some really good news announcements that come out from that, and some really great leadership that stems from it.
Well, thanks, Eddie. Thanks, Rene, for inviting me on. It's been a real pleasure, and I look forward to reporting back from COP.
Yeah, thanks, Ed. All right, safe
thanks
travels.
very much.